The market is open where we're seeing mixed performances right across the board. Those ones, in fact, that had some very impressive runs, like tech stocks and semiconductors, on a bit of a cooldown, and those more unloved, and in particular dividend stocks, are starting to make some gain today, but we shouldn't be surprised to see a cool down, something we could see continue into the end of the week, as we are making new all-time highs. Just in fact, the end of the month, the S&P hit a record $55 trillion, something that bottomed at $44 trillion during Liberation Day, and now we are moving into the second half of 2025. It is nice just to look back and reflect on those stocks that had some incredible performances. The number one spot, one that maybe you would think is unlikely given how stretched the valuation is, Palantir sitting there up 79%. We also have some other names that we've covered on the channel, like Uber up 55%, CVS Health also very strong, up 54%, and yet investor sentiment still looks pretty strong, sitting 66 greed, which ultimately does mean companies are looking less and less attractive. And that is why in today's focus we want to be looking at not just strong growth stocks to consider for the portfolio, clearly those that also look attractive, but for those also who like to buy shares covered calls, we're looking specifically at under $100. Now, before we do that, a quick market update where we see the reignition of the Donald Trump and Elon Musk feud. We have the president saying that he will take a look at potentially deporting Elon. And one thing investors don't like to see is this political rift where the company is not only down around 5% today, although granted we do notice up 44% over the last year. It's down year to date 25%. They've had 1/4 of their market cap just wiped out in a matter of months. Over the last 6 months, down 20%, over the last month, down 10%, and just in the last 5 days, down around 7%. Interestingly, whilst it is trading towards the lower end of the 52-week range, every single analyst believes this company is a hold. And then we have some news, in fact, from a few of the Mag 7s, starting off with Amazon, where they've said they've now deployed over 1 million robots in their warehouse, and we can see from the graph it's only increasing as the years go on, and we do expect this to really come through on their bottom line, on their margins, and in turn really give value to shareholders, which perhaps is why we see it trading near the upper end of the 52-week range, and still both Wall Street and Quant give this a strong buy. Seeking Alpha also with a buy. We may not be far from seeing a triple strong buy, something we've noted on very rare occasions like we saw with Taiwan Semiconductors a few months ago. And then we see Meta, where in fact the CEOs announced a major restructuring of the company's artificial intelligence group. This includes a commitment to developing AI superintelligence that can complete tasks as well as or better than humans, and they've called this the Meta Superintelligence Lab, MSL, which Zuckerberg has said they plan to spend hundreds of billions on AI projects and research in the years to come. And they've also hired 11 new researchers. Remember, just on the episode yesterday, we did talk about how they're poaching staff from OpenAI with promises of bonuses at around $100 million. Now, the company itself, whilst down today like the majority in the tech space, it is up 43% over the last year, year to date up 23%, trading at the upper end of the 52-week range with a strong buy rating from Wall Street. And whilst we're not going to go into any depth on the company, we will just highlight that based on the forward P of 28, it does sit above the 5-year of 23, so we would call this in an overvaluation space, one that is only confirmed when we take a look at the blue tunnel methodology. Remember, this highlights the parameters within the intrinsic price. Right now we do sit above even the upper end, so an overvaluation signal, although if you did buy during Liberation Day, we did notice severe undervaluation. In fact, if you were someone that was buying the lows around 2022, again, severe undervaluation. Definitely something though to ponder, as we do know right now, in our opinion, it is overvalued. We then have Apple rise from the dead, a company that has been on a bit of a downward trend lately, where they're considering using Anthropic or in fact OpenAI to power Siri, not something that analysts were expecting, taking them at a bit of a surprise. And remember, we covered not long ago that Apple executives were reportedly considering buying Perplexity, which would make it the biggest ever acquisition with a price around $14 billion. And one of the reasons why we don't typically talk about Apple Apple, it doesn't look like at the moment there are many growth catalysts. If we just look at the prospects of the new iPhone 17, which is anticipated to drop in the next few months, where we'll get a bit more information soon, it does look like just a copy and a rehash of previous models. We're talking a larger battery, better phone graphics, maybe one or two additional buttons, something that really consumers don't want. Yet the company is up around 1.3% today, still down over the last year 4%, year to date down around 17%, and currently sits towards the lower end of the 52-week range, and just one very weak buy rating from Wall Street, 3.89 out of 5. And similar to what we saw from Meta Platforms, we would say this does look to be fairly valued, reasonable signal, forward P not far off their historical, and that's something that's also confirmed when we take a look at this model, pretty much sitting bang in the middle. If we zoom out, this is one that's incredibly rare to buy at a severely undervalued signal, something really worth considering if you want this in the portfolio. We then move on to Waymo, which continues to get stronger and stronger. We do notice, in fact, they now have 250,000 paid trips per week this year. That is up 5% from 1 year ago today. Now imagine how much this will be in 1 year's time, something that is really overlooked when investors consider the company. They specifically go to search, which they do consider to be a dying business, something that is yet to come up in the numbers. And we can see the company down around 4% over the last year, year to date down around 8%, trading around the midpoint of the 52-week range with a double buy from Seeking Alpha and Wall Street, both of them near the 4.5 in fact, that would flip them into a strong buy. And we get the undervaluation signal, forward P of 19 below the 5-year of 22, which is also reconfirmed when we take a look here. Severe undervaluation, it is lower than even the bottom end. But when we zoom out, as we've said before, this is one company that does historically look to be unloved by the market, as it has traded in a severe undervaluation for many years. We also have news from Microsoft where they have just announced a 5-year partnership with the Premier League. They're going to become the official cloud and AI partner for the Premier League's digital platform, modernizing the league's digital infrastructure, broadcast match analysis, and organizational operations. And this company is down around 1%. Now, over the last year, not great, up only 8%, year to date up 17%, currently trading near their all-time highs, with still Wall Street maintaining a strong buy. And we can see, similar to Meta Platforms, it is trading above the historical 5-year. That is an overvaluation signal. Yet when we take a look at the blue tunnel, it is sitting right at the upper end, so you could argue still slight reasonable valuation. And it's also fascinating, something that we came across today that we wanted to share, that when we look at OpenAI, they generated $1 billion of revenue in 2023, $4 billion in 2024, and is expected to generate around $13 billion in 2025, one which is only expected to increase more and more. And what makes it even interesting, on the back of just looking at Microsoft, well, they themselves get 20% of OpenAI's revenue, up to $92 billion. So look, this is something we thought was quite fascinating, we wanted to share, and also quite interesting if you are a user of the likes of ChatGPT. Now, moving away from the tech sector and to Hershey's, they've announced something that we've seen quite a lot now, which you could argue has something to do with RFK, but they're dropping synthetic dyes from their snacks by 2027, and like most of the unloved dividend stocks that have been battered, they are up, but quite significantly, nearly 6%, still down 4% over the last year, year to date up 3.5%, trading at the midpoint of the 52-week range. And just as we saw in fact from Tesla, all three analysts do believe this company is a hold. Yet when we look at the forward P, we have a screaming overvaluation, 30.4, well above the 5-year of 24, yet investors are now offered a higher yield of 3% than the 5-year that sits at 2%, and that overvaluation is confirmed. Not great as well to see the expected price decrease, but it does right now, as a trading price, sit above the upper end of the blue tunnel. And then moving into the semiconductor space, whether you take this as good news or not, but we have ARK Invest, managed by Cathie Wood, adding yesterday 241,000 shares of AMD, a semiconductor that has been on a very strong run lately, and we see it cooling down today, down around 3%. Now, it is down around 13 over the last year, year to date up 14, and currently trading in the midpoint of the 52-week range, with a double buy from both Seeking Alpha as well as Wall Street. And we have some breaking news that the Senate has now passed Donald Trump's tax and spending cut bill. Now, when the Senate passes this, in fact, it generally signals a bullish effect on stock. Lower taxes, ultimately higher profits. Corporate tax cuts increase the company profits, which often boosts the stock prices. We then get increased consumer spending, so personal tax cuts leave people with more disposable income, potentially boosting sales and earnings, as well as invest optimism, so markets we would expect to respond positively to pro-business policies, leading to bullish momentum. However, there are also long-term risks like increased deficits from the spending cuts, which could cause further bearish sentiment if they lead to inflation or higher interest rates. But in terms of a bottom line, short term, this kind of bill is typically bullish for the market. And perhaps we have some positive news for someone that isn't on Donald Trump's Christmas list, is Jerome Powell, who is signaling potential openness to a July interest rate cut, something that Donald Trump has been hounding him on for quite some time and believes he should be doing a huge cut down to around the 1% level. Whether or not we get a big cut in July, definitely something to keep an eye on and see how the market does react. And before we uncover the stocks today, we want to let you know that we have released our latest free weekly article. We draw on every single Monday morning to your inbox completely for free, where we cover severely undervalued stocks as well as what's gone in the market in the last few days. So click below, you can sign up and read straight away, where you'll be able to gain access to severely undervalued stocks for the month of June, although this is just to highlight what there will be in July's copy that is in fact dropping tomorrow morning. Lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that you can grab a recently released copy of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. Stock number one, we have Marvell Technology, and it's not one of those names that you hear that often, so let's just discuss firstly what they do. They're a semiconductor company that designs and develops high-performance chips, but they don't make the smartphones or the consumer tech like Nvidia or AMD. Instead, they power the infrastructure behind the data center, 5G networks, AI workloads, and cloud computing. They're the chips that are used by hyperscalers like Amazon, Microsoft, and Google, and they're increasingly crucial as AI models grow larger and need faster, more efficient networking and storage, whilst also playing a key role in automotive and enterprise networking, so it's a diversified business but with real exposure to AI. Now the company is up around 8% over the last year. Year to date, however, down around 31%, but still over the last 10 years, longer term shareholders massively outperforming the S&P, up 513%. Right now trading towards the lower end of the 52-week range, and this is one we covered not too long ago. If you did buy at that point, you would be up around 10%, and we can see both Wall Street and Seeking Alpha giving this company a buy. Not only that, Wall Street very near to the 4.5 that would flip this into a strong buy rating. Now in terms of the forward P, it sits at 25.8, which is much lower than the 5-year average of 35.1. This is what we would call a severe undervaluation signal, which is also confirmed when we take a look at this model. As you can see, disparity between the bottom end and where the company sits. And what's also nice to see is the intrinsic price increasing over time, while seeing the share price do the opposite, decreasing. This is what we would identify as a very great opportunity. And if we zoom out to the last 5 years, we can see this company on a bit of a roller coaster ride. Some years trading in severe overvaluation, others, as we note, and in fact not just now but also in 2022, at a severely undervalued one. Now their growth comes in at an A, where year on year and forward looking we're talking 21-22%, well above the sector in the mid-single digit, and in fact they're increasing faster than what they have done on the last 5 years in terms of revenue growth, whilst expecting EPS to increase 46% over the next 3 to 5 years, well above the sector at 14 and well above their own historicals at 25. And love to see this green right across the board. Not only that, out of the next 4 quarters, they're expecting every single one to be double-digit growth at a bare minimum. Next quarter, triple-digit, with a 100% track record, 4 out of 4 beats against analyst targets, and they're trading on their next full accounting period at a forward P below 22. Now, institutions do hold around 84% ownership, where they've sold 10 billion in just the last year. However, same time frame, they've bought a bit more at 13 billion, and we also noticed that in Q1 they've been buying more than they have been selling, something we can see up until Q1 2024, where we note the reversal. Now, our intrinsic price gets to just under $85, where we have used the DCF model. Now, we'll show you how we've got to that figure. We have the free cash flow year on year. Most recent increase sits at 35%, and we have tried to be a bit more conservative moving forwards at 17.5. What you will notice, negative 42, it is in a cyclical industry. We have seen it go from negative to positive a number of years, and you will note a low, medium and high, 15, 17.5 and 20 in terms of growth rates. As always, numbers here are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Marvel or any others. But based on the growth rate and the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, get to $85, indicating 10% upside. Now, you may believe that's too high and want to be more conservative. At 15%, $70, indicating overvaluation, downside of 9, or you may be a lot more bullish and believe 20% to be the most appropriate rate, 101, indicating 31. And as we typically do on the channel, we will take through the medium rate of 17.5, where we're not done there because we always apply an MOS, 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that in the episode, a buy with a 10% margin of safety, Wall Street themselves see this at $92 into 2026, upside of 19%. Now, you may like the company but want a larger margin of safety. At 15%, a buy at 72. At 20, around 68, which is where we saw it not that long ago when we covered it in the more recent period. And for those that want this at 25, around the $63 mark. Marvel Technology at the moment, 10% MOS, 19% upside. Give us your thoughts whether you see this as a buy, hold or sell. We then move on to BAE Systems, and they aren't just a defense contractor, they're one of the most strategically important companies in the UK and globally. They build advanced military equipment. We're talking fighter jets like the Eurofighter Typhoon, nuclear submarines for the Royal Navy, radar systems, cyber defense tools, and high-grade electronics that's used across land, sea, air, and now increasingly space and cyber. They're also a top supplier to the UK and US government, but their reach goes far beyond, working with NATO allies and key partners in Europe, Middle East and Asia Pacific. And with global defense, as we've highlighted before, spending at record high, rising tensions with China, the ongoing war in Ukraine, they have seen a major uplift in orders and long-term contracts. What does make it stand out amongst everything though is not just the backlog of over 60 billion, but the predictability of their cash flows, strong dividend track record, and the fact they operate in an industry with huge political tailwinds and high barriers to entry. Now, you will have to forgive us as this one is just marginally above the $100 mark, and they're up 60% over the last year. Year to date up 81, and over the last 10 years, massive outperformance of the S&P, up 251. Trading at the upper end of the 52-week range, we get a strong buy rating from Wall Street with a buy from Seeking Alpha. As we said, a yield currently sitting around 1.7% and a forward P around the 25 mark. Now, they do get a D on the valuation purely down to the fact that the sector sits lower at around 20, so you are paying a 29% premium, and over the last 5 years they do sit above the 15.7, so you're also paying 63% more than they have historically been valued at, something we see consistent across every single valuation metric. Now, they do get an F on the growth, but we're talking year on year 14%, forward-looking 12%, well above not only the sector in the mid-single digit, but also their own 5-year, and EPS is projected to grow around 13 to 14%, again above both sector and their own 5-year. They also expect EPS to grow more than 10% into 2026, lowering the forward P to 22.6 from a next accounting period standing point. And whilst we see institutional ownership very low considering this is from a US perspective, we still note 12 million worth of selling but a lot more buying at 24 million, something we see quite a large chunk in fact in quarter one, 22 million buying, 5 million selling. Institutions, at least in the more recent period, a lot more bullish. Now, our intrinsic value at $127 is purely the average of the three models that you see on screen, and you are getting a margin of safety at 10% up to 114, at 20% around 102, so not that far off. We saw Wall Street with their strong buy rating, 20% MOS, we get a forecasted price of 114, that was the average, sitting at 11% into 2026. But give us your thoughts. If you want to see 25, that would be around $95, and at 30, around $89. BAE Systems, 20% MOS, buy, hold or sell. We then move on to Nubank, one of the world's largest digital banks, and it's completely reshaping how banking is done in Latin America. Based in Brazil, they've built a mobile-first, fully digital platform that offers everything from credit cards and saving accounts to insurance, personal loans, and investment products, all with 0 physical branches. They've also attracted over 100 million customers across Brazil, Mexico, and Colombia, and what's impressive is how fast they've scaled while staying profitable in a region that's traditionally been underserved by legacy banks. Now, the real edge comes from the fact that they combine sleek tech, low fees, and a massive data advantage, allowing them to underwrite loans, cross-sell services, and grow customer relationships in a way that's more like a fintech than a traditional bank. Now, it's up around 10% over the last year, and year to date up around 31%, trading around the mid to upper end of the 52-week range. Again, another stock when we previously covered it months ago, up more than 10%, with still every single analyst giving this a buy rating, and a forward P sitting under the 26 level. Now, the grading does sit at a C-, pretty much telling us you are paying a premium against others in the sector, but perhaps this is seen as being warranted given the growth sits at an A, year-on-year revenue and forward-looking around the 32-33% mark, well above the sector in the mid-single digit. However, worth noting, they were growing at a faster rate over the last 5 years, and EBIT growth forward-looking very strong, 54%, the same to be said around the other metrics here. Finally, they do anticipate the next 4 quarters all to be double-digit growth to the EPS, 100% track record, trading on December 26 at a forward P bang on 19. Institutions clearly love this too, 84% ownership, 4.8 billion worth of selling, 7 billion, a lot more buys, and we also notice in fact more than double the buys in quarter one than we can see sells. Now, our intrinsic value gets to just under $17, which means you are getting a healthy MOS. At 10%, a buy at 15, at 20 is pretty much where we see the company, with Wall Street themselves $16 price target. They anticipate 19% upside. Again, for those that want to see it 25, a buy at $12.50, and for those that want to see it 30, just under $12. So 20% MOS, Nubank, in your opinion, buy, hold or sell, maybe one on your watch list, or in fact you don't like it for whatever reason. The next stock is in fact Uber, and what they do today is very different to the company it was 5 years ago. Yes, it is still the world's largest ride-hailing platform, but they now offer a full-scale logistics system. You've got rides, eats, and freight, moving people, food, and cargo across 70 plus countries, and crucially, it's doing this with real profitability, growing free cash flow. But what makes it special now is the fact it's leaning into AI as well as autonomy. In the UK, they've just announced a partnership with Wavy, a London-based startup developing AI-powered self-driving cars that learn from real-world data and not just pre-mapped roads. So it's a big step towards their long-term goal, reducing driver costs, scaling autonomous mobility in complex urban environments. So between the global scale, growing margins, and now pushing into next-gen AI transport, the question is, does the company have room to run, or is the upside already priced in? Now straight away we see a strong buy from Quant, very healthy signals as well from Seeking Alpha and Wall Street with the double buy, trading near their all-time and 52-week high with a forward P around 32-33, up 28% in the last 12 months, and as we saw at the beginning of the episode, one of the best companies in terms of the first half of the year, up 52%. Over the last 5 years, significant outperformance of the S&P, up 201. Now they do get a deal on the valuation, but we do believe right now for the company it is justified to be trading at a premium of what we see 30% to the overall sector. Their growth looks strong at an A, year on year 17-18%, around 16 expected moving forwards, well above the mid-single digit of the sector, although we do see a bit of a slowdown in comparison to their 5-year, with EPS projected 26%, a lot better than the sector at 11.4. However, only one of the next 4 quarters is anticipated to be growth, with a 100% historical track record, trading on next year's numbers at a forward P of 26.7. Now, institutions own around 80%, with 14 billion worth of selling, 21 billion buys, so 50% more buys than sells. And whilst we're waiting for the full data for quarter 2, we can see quarter 1 more buying than selling. In fact, you would have to go quite some way, we're talking Q3 22, to see the reversal, where institutions did sell more. And our intrinsic price at $104 is derived using a growth rate of 10%, one that you could argue is very conservative. Last year up 105, previous year up 762. In fact, it's really good to highlight that if you believe 8% is correct, the company is fairly valued, meaning for those that are buying today, already baked into the numbers is 8% growth to the future free cash flows. Now taking through the 10% to really highlight the margin of safety that we can see today, at 10%, a buy at 94, at 15, not far off there around the $89 mark. Wall Street themselves, they see $100 price target, upside of 10% into 2026. Give us your thoughts. We'll also highlight at 20%, a buy at 84, at 25, 78, and this is one we continue to talk about, and it only continues to climb. Uber then 15% MOS, 10% upside. Give us your thoughts. We then move on to JD.com, one of China's largest e-commerce companies, but unlike Alibaba, it runs more like Amazon. They own and operate their warehouses, logistic networks, and delivery fleet, which means they control the entire customer experience from order to doorstep. They also sell both first-party goods like electronics, appliances, and groceries, and they also host third-party sellers on their platform, with this hybrid model helping them build a reputation for fast delivery, authentic products, which is especially important in China's massive but highly competitive online market. They also have a logistics spin-off, JD Logistics, a fintech arm, and they're increasingly investing in AI automation from smart warehouses to drone and robot deliveries. However, we do have to consider the Chinese economy, which does look like it is slowing down, as well as regulation tightening, but this could be one for great long-term growth. Another one today with a strong buy from Wall Street, as well as a buy from Seeking Alpha, trading at the mid to low end of the 52-week range. Now it is up 27% over the last year, down 5 year to date, and over the last 5 years it is also down 45%. We can see 52-week high at the $48 mark. It does offer a yield around the 3% level with a very low forward PE, in fact below 8, which is probably why we get the A on the valuation grading. Not only are you getting a 54% discount against the sector, but also 71% to their own historical average. Pretty much discount no matter which valuation metric you take a look at today. Now the growth does get a D-, but we're seeing fairly attractive year-on-year 9%, 8 in terms of anticipation moving forwards, well above the sector in the low single digit. However, a bit of a letdown given their last 5 years they were growing at a double-digit rate, and EPS 8 to 9% projected, below the sector at 10.5 and their own 5-year at 24, and only one of the next 4 quarters is anticipated to show growth to the earnings per share. However, we do note here 100% track record, some sizable beats, trading on next full accounting period below a forward P of 7, so you could consider this as a very strong value play. And we have institutional ownership 16%, where in fact they sold 2 billion of shares, but they bought twice as much in the period, and they bought a lot more in Q1, nearly in fact 1 billion buys with 172 million worth of selling, something you can see the reversal in Q2 24. Now our intrinsic price gets to $47, which does show quite a large MOS, in fact the most we have seen today, but some investors may either not want to invest in China or want a larger margin of safety. Today though, we see this at 30%. Wall Street themselves, the largest upside today at 45%, price target $48. We'll also just show you at 35%, a buy at 31, at 40, 28, at 45, 26, and at 50, the $24 mark. Having said that though, at the moment, JD.com, 30% MOS, 45% upside. Give us your thoughts. Buy, hold or sell, as well as the others we have covered in the episode. And don't forget as always to sign up to the free weekly newsletter, grab those spreadsheets, come and join us at Patreon where we cover our buys and sells. And as always, have a great day. We'll see you all on the next one.